But just want to welcome everybody to this event this evening where we're going to talk about market uncertainty, and we're going to talk about whether or not it makes sense to invest in this market and the type of investing that may make sense for you as an investor, whether you are a passive investor or an active investor. I think there's two sides of the coin there, and either one has the ability to participate in this market, no matter if it's up or down. One thing I always tell people is, hey, I've been in this business 30 years. I've seen a lot of up cycles. I've seen a lot of down cycles, and I've learned to make money on the ups. I've learned to make money on the downs. Of course, when the wind is at your back and you're going up, it's a lot easier to make money than it is in that down cycle. But, I've been learning more and more about cycles lately, and being that, these cycles can last 8 to 16 years. And you don't know where that cycle's going to change. So we'll talk a lot about that tonight, but I just want to welcome everybody. The chat is open. So if anybody has questions, please throw your name in the chat and let us know what your question is. We'll monitor that tonight and just kind of kick this thing off. Let me introduce myself. I'm Mike Morawski. I'm with Resilience Equity. We are a small multi-family equity group out of Illinois. And I have a couple of partners on my team that help with all the day-to-day stuff, and a very sharp underwriter that helps look at deals, source deals, and see if we have anything that makes sense to bring to the market. We're currently active in a couple of different markets, Florida, Texas, and we have some pending properties that we're going to be closing in the Tulsa, Oklahoma market, and we also own some assets in the Tulsa market. So I'm excited about where the market's at and where things are headed, and how we have the ability to be able to help other investors to achieve financial wealth for themselves. And I look at it this way. I always say three things, right? I want to create passive short-term income for people. I want to create long-term wealth for people, and I want to help with tax planning strategies. And if I can fill those three buckets when I bring a deal to the market as a syndicated deal, where we share in those profits with passive investors, that's where I really feel that I fulfilled, somebody else's life. So it's about, I have two missions in this business. One is to provide safe and secure housing for my tenants. And the second one is to provide some generational wealth for my investors on the other side. So glad you guys are here tonight. I'm going to start with Joseph. Joseph, if you take a minute and introduce yourself, and we'll get everybody to introduce themselves and just kick this thing off.
Good evening, Michael. Thank you. My name is Joe Scarice. I'm a certified private lender, national sales director at Burr Loans. Been in the lending space 24 years now, celebrating, and 36 years as a licensed realtor in several states. And I teach continuing education on asset-based lending and hard money at Temple University at the Real Estate School for real estate agents for the state of Pennsylvania and state of New Jersey. So I'm here to hopefully provide some insight and strategy and understanding from an investor perspective, and hopefully I could be of any help in some questions and answers.
Thanks, Joseph. Glad that you're here tonight. Hey, Matt, how about you?
Hello, everyone. My name is Matt Ferguson. I am based out of St. Paul, Minnesota. I work for a firm called Chicagoland 1031 Exchange that's actually based out of the greater Chicago area. And I'm a financial advisor. I do a number of different things for my clients. But one of the things that I focus on, especially lately, is helping clients defer taxes when they sell real estate and other appreciated assets through the use of 1031 exchanges and qualified opportunity zones. And just going to try to see what kind of value I can add to the panel as far as my experience as an advisor working directly with clients who have, we're looking at their entire comprehensive financial planning needs, but also as somebody who's been in real estate for 17 years. So I've seen a few cycles myself. And like Mike said, I think that understanding the cycles and studying them is important, but there's always opportunities both on the upside and the downside. So we'll see if we can add value on that topic today.
Great. Glad you're here, Matt. Thanks. And Matt, you and I had this idea of of having this panel event a couple months ago and kind of been talking about it on and off, and we finally put it together. So I'm glad that we had the opportunity to do that. Raymond, how are you tonight?
Excellent. Mike, glad to be here. Raymond Lord, I'm with SVN. I am a multifamily broker. I've been in the industry since 1987. That'll date me a little bit, 35 years now. I started in fee management, went into the brokerage probably about 22 years ago now. We do between 2,000 and 4,000 units of sales and dispositions and acquisitions a year, mostly in the Midwest, core markets like Texas, Oklahoma, Arkansas, etc. But I do have some deals working in Georgia, North Carolina, South Carolina, and Tennessee. So we kind of work all over the country. I've been involved in apartments, like I said, for 35 years. I've been through a number of cycles, both on the positive and negative side. Been able to watch and understand how fundamentally the markets change and how to take advantage of what goes on when those markets do change.
Yeah, thank you. Appreciate you being here. All right, guys. So what I'd like to try and do this evening is, have a array of questions, some individually for, maybe Ray or Joseph or Matt, and some group questions. And I want to kind of kick off with a group question that, if each one of you would take a minute to answer, let's try and, so we can get through a lot, right? A lot of data, a lot of material for people. Let's, try and keep our answers as concise as possible as we can, but, kind of at least drive the message home, right? So, Ray, why don't we start with you?
Sure.
We kind of, I kind of marketed this event this evening as being the uncertainty in the market. Mm-hmm. And I think that, if we look at it, there's two bookends today that we have. And one bookend is the investor who says, I'm not going to invest right now because I know next week there's going to be a better deal that comes to the market. But here's the problem I see with that thought process is that those good deals that come to the market, you're going to have the lenders like Freddie and Fannie that are going to pick up the phone. They're going to call an experienced operator and say, I have this stressed deal. Will you take it over? It's never going to hit the market to an average guy like us.
No.
And the other side of the bookend is the investor that says, I'm afraid. I'm afraid that the market's going to change, that America's going to go to war, whatever. But what is your thoughts around the uncertainty out there today?
So you actually covered a kind of a double, a pretty broad range. It's a great question. I get it. To answer your question, you're 100% correct. A lot of times an asset will hit the market. It will never, ever be out to the public, so to speak. It will get traded on the back side. I don't want to call it insider trading, but it'll get traded underneath the table, and nobody will ever know that it ever was a distressed asset. Case in point, I've seen it. I've seen several of these downturns, and we get called quite frequently to do analysis on these properties. And they do get traded off market, and they go to select clients that get to reap the benefit. Number two, with regards to uncertainty in the market and concerns, understand we have a growing population. Rental is becoming absolutely more and more normal, and people wanting to rent. And we're seeing a huge increase in not just performance of properties, but also occupancies. And our rents are still, especially in certain markets. There are other markets that are overblown, like Los Angeles, Miami, New York, etc. But core markets where you still see a significant amount of rental upside. And a lot of people are choosing to rent by choice, not by, necessity. And so that's still going to be a strong factor. And it's pushing. The case in point, I'm in Houston, Texas today, working on not a huge asset. It's 248 units, but a good sized property. and the property is probably under market by about 22% on the rental side, and the occupancy is 100%, and there's a reason why. It's 22% under rents. So, we're here to instruct and work with the current principals to show them, how to bring the property up to par and what they need to do. And it's very minimal stuff. But performance on properties that we're seeing across the board are stronger than I've ever seen in 35 years. And, I expect that trend to continue for the foreseeable future. Anyway, that's.
Thanks. Appreciate that. Joseph, how about you? Any thoughts on it?
Unfortunately, some economists are skeptical that the U.S. can maintain an economic growth with interest rates so high. U.S. GDP growth is going to be about 0.8% in 2024, which includes a shallow recession. Just today, one of our largest banks announced they're closing about 25 of their branches. Not a lot of branches, but it's enough to make an impact in several states. I think we're in for a very opportunistic time for the vultures in 2024. I don't really see a rebound return to growth till 2025. You have a very interesting storm, multiple storms at the same time. You have a $1 trillion reset in the office retail space. You have a massive conversion of office retail to multifamily eat, work, and live. You're bringing eat, work, and live and BTR to the front line, which is being funded 100% by institutions, which is going to be ended up around 40% of our rental base throughout the country, probably within the next 5 years. What happens to the little landlord or the medium-sized landlord? How are they going to be impacted with the Fed now mandating, rent control potentials in every urban city in the country, low-income housing requirements in all these buildings? How will that impact the little person that needs debt, where the institutions don't need debt? And the institutions are the same lenders in the asset-based lending space. And as the Fed is being pressured by cannons by the government to slow down on hiking the rate, and if they don't hike the rate, the banks get crushed, aka PNC today made a very, very, very important move there that's telling us how there's going to be more merger and acquisitions and shutdowns in the banking industry. So where's the money coming from for the little person? It's coming from the asset-based lending space, whether it's SFR or multifamily or mixed use with a residential blend. So you got a lot of things going into 24, a presidential election. You got geopolitical issues. You got wars all over the place. You have poor economic structure because the government created the inflation. So I think this is a unique opportunity for investors to jump in on the parade in 24, where the homeowner or home buyer is going to become a long-term renter for the next 2 to 3 years.
Yeah, well spoken. Thank you. Hey, Matt, how about you? What are you seeing from your end on uncertainty or investor confusion?
I think investor confusion is probably one of the things I deal with the most as far as talking. When I talk to investors, I guess I see that they're confused because on one hand you hear people say things like, "Oh, it's a good time to get a deal on properties that have to be sold." On the other hand, you hear things like, "Oh, office properties are consolidating and way under occupancy," and so it's just like, well, what should I buy? Should I buy anything? And so what we're doing at our firm is, obviously listening to investors' needs, but then also, finding the deals that still make sense today. So what Joe mentioned, maybe not returning to growth till 25, that's very real. One of the things that I've heard echoed from some of the institutional sponsors that I work with of investment properties is the term survive till 25. And that's kind of coming from on the developer side. So one thing that's very interesting right now that's going on is, so people are concerned about, well, should I buy property right now? Should I be investing in real estate with or without debt, depending on the, what asset class should it be? And so what's happening is there's definitely a tightening of the belt on the development side because people are reluctant to start new projects. So there is a lot of opportunities today in existing product, in the sense that, okay, so you could buy something today. Is it the perfect time to buy it? What kind of debt can you get? Maybe you put a little bit lower amount of debt on it than you normally would. Maybe you're not loving the interest rate you're going to get. But here's the thing: if there's no new development starting today, there's going to be a large surplus coming, and that what we're seeing is about 3 to 5 years out. Even in markets that have, well, very few markets actually have enough rental housing opportunities right now. So most large markets, despite whatever you hear, that there's a housing shortage across
the country. There's a demand.
Yep, there's a demand, and a big part of that demand is fueled because of the lack of development that happened all the way back in 2008.
Yeah.
And so that last recession created that opportunity in our side because, hey, there's a demand for property, so it makes it easy to find deals as far as make deals work out for the long term. And so I'll kind of put a bow on it on that topic and just say there are opportunities today, especially in the multifamily side, and whether or not the cash flow is exactly what you want or it pencils out perfectly, hopefully there's an opportunity to make it up in the back end when you go to sell the property or even refinance it once there's an even bigger shortage of properties due to the lack of development that's coming.
Yeah, very interesting. Hey, Ray, I want to ask a question about rents, right? And how badly, if at all, are rents being affected? And let's just talk specifically about your region, that Northwest Arkansas, Oklahoma market, that Midwest market. How bad, if at all, are rents being affected by what's going on in the market today?
So we're in the market today, rents are not being affected whatsoever. As a matter of fact, if anything, they're still seeing increases. Now, we are not seeing the increases that we saw 2-3 years ago, where we were seeing close to double digit, which is unheard of, 7, 8, 9%. It's tapered back a little bit more towards about a 5% to 8% range, depending upon what market. Specifically, Northwest Arkansas is incredibly strong. There is a huge shortage. We had one asset over there, new construction, 241 units. They had a absorption calculation of 8 months. It filled up in 2.5. So you do the math. I mean, that's just crazy. And the rents are coming in at close to $2 a foot. Specifically, other markets on the secondary, say B and C class, where they're well managed and well operated, we're seeing about a 5 to 7% rent growth per year, which is well above, which is typically a 3% over a 20-30 year period. So that's continuing, and that's part of that in quote unquote inflation component that we're seeing across the board. But we're not seeing a let off on the rent increases, because there's, Matt had it dead on. There's such a demand. There was such a delay of construction of new product for an extended period of time that we have now a backlog of demand for new rental properties, especially in the affordable workforce housing. I can't tell you I'm getting calls left and right on that component every day.
Well, one of the things that I'm seeing is specifically in the Tulsa market, really where your home base is that I'm getting higher rent growth than I anticipated. So I have a deal that, we thought the rent was maxed out at $775 for a 2-bedroom, and we're getting 9.25.
9 plus.
It's amazing to me that people think, rents are going to back off, but we've really become a renter's nation, so to say. And
understand it's partially by what has occurred historically, but also by desire. A lot of people are going, look, I don't want to be tied down to a 30-year note on a house, et cetera. I want to be able to move into a place, have it, and then if I need to move and go to another market, Kansas City or wherever, I could do that. I'm not tied down with a sale or whatnot. Also, qualifying, and Joseph can probably speak more to this than I could, but qualifying for an SFR today is a little bit more challenging than it was historically. If there was a period where money was pretty loose and free, and that's, I think, probably back a little bit on the SFR thing. So.
Yeah, interesting.
Well, definitely echo what you're saying, Ray, about a desire to rent. We've done a number of exchanges for people who are looking to defer their taxes on the sale of real estate and put them into, at least as part of a portfolio, into properties called build to rent. And that's, it's been around for a number of years, but it's definitely gaining much more steam, where these are properties that are, we've done a lot of business with Class A properties where folks are getting a really nice, apartment with a lot of amenities, saltwater swimming pool, all kinds of things like that. But increasingly, people are more and more interested in living in these build to rent communities. And if you were to tour them, you'd say, boy, this looks like a bunch of townhomes or a bunch of row houses all together. But it's a lot of things where there's a house,
built for rent,
an individual, sometimes completely detached house, or, number of units in a row where you have multiple stories and your own attached garage.
Right.
And that build to rent asset class is really taking off due to just the desire for people to rent rather than own. And then when they do that, they want something nice. They still want a nice place to live,
Sure.
but they're just not interested.
Not the responsibility.
In some cases, not able, but a lot of them are just simply not interested in whatever phase of life they're in to own a home.
Yeah, very true. Hey, Joseph, so I was on an interesting conference call today, and it was a group that's looking for equity. They're doing a new construction project in the Dallas market, and they have HUD financing in place at 5.75% interest. Now, I find that, when he said that, I was taken back a little bit, knowing that if I underwrite a deal today, I'm looking at 7.75% interest. I have rates now. I know the 10-year Treasury's backed off here a little bit. It's went down like 10% today. But what effect does that Treasury have on interest rates, and why can somebody have a new construction loan, a builder's loan, with projected takeout money at 5 and the orders?
Well, again, I don't know who's financing or floating that loan, but is it 10-year money? Is it 7-year money? Is it 5-year money on a 30-year amortized loan? I mean, HUD, sometimes it's even longer amortized loans.
35,
yeah, 35. So I'd have to know a little more about that loan. And the minute I hear equity, that there's a need for equity, that means that somebody doesn't have enough money to get to the closing table. And that's usually the shortfall in a lot of these developments. Dallas is not as frothy as it once was. I mean, the rental signs are up. Availability is up. It's not as appealing as it once was about 5 or so years ago. It's a little quieter. It's got to be. You got to have transportation there. You're not going to get anywhere around Dallas. But I hear some of what Raymond's saying and what Matt's saying. The old phrase of "Go West, son." It's not "Go West, son" anymore. It's "Go Southwest, son" or "Go Southeast, son." Florida, you got to stay away from because it's cresting. Maybe Tallahassee and Jacksonville might still have some light opportunities. Alabama, Jackson, Mississippi area is starting to really rise to the occasion.
Yep.
I love Arkansas. I like Oklahoma. I like Indiana. I really like Wisconsin, because if you follow the migration reports of rental migration reports, not migration reports for people to buy homes, migration rental reports. People are looking at the demand for rental properties and what their costs and overheads are, where they can work virtually, where there's actually a precautionary environment of potential the next COVID that the government might throw at us. So people want to live in areas where they're not going to get chained down into their house and not allowed out of their house. So they're looking at friendlier states that are going to welcome them, like Florida did. Look what happened to Florida. Half of Long Island in New York moved to Florida suddenly. And and half of New Jersey and Long Island moved to North Carolina. So because they were much friendlier states during COVID. So the tenants are no different. They want their freedoms as well if they're going to pay, a decent buck for a rent. And this is another thing. If you evaluate the PITI of a home today compared to rent, the median across the country, the median rent is $1,800. The median PITIA is $2,500. So you tell me, where everybody lost their reserves, bunkering down, losing jobs during COVID, they don't have money to put down on a home. Where are they going to go? Why would they buy, even with 100% financing, with the uncertainty that most of these properties are overpriced? We're in declining markets in the Northeast and the West Coast. Everybody's going right inverted into the Midwest. I mean, that's where I focus right now in my rental opportunities with working with clients. So there's no difference from SFR to multifamily. All of it's being impacted on both coasts. And the play is in really spin off a lot of cash as an investor over the next 5 to 10 years. Is going to be in the Midwest to Southwest markets.
Yeah,
I agree with that.
I go back.
And I'll also point out that there are opportunities, I think, everywhere. I think that that's important. When we start to make these generalized statements, I mean, that doesn't mean that if you're an investor in the Northeast or even say, you're going to find a deal or a good investment.
There's always this. But I'm just saying,
for sure, the sponsors that I'm working with primarily are historically, the last few years have been in that Southeast area. Sebastian, you mentioned what do we think of Raleigh? I'll weigh in on that. I work for a sponsor that did a 1031 exchange DST in Raleigh, Charlotte, a number of properties in there. Great markets. We saw some great rent growth, and I think that there's still opportunities there. But that definitely was really seeing a big. I'm going to throw that in with the Southeast. I don't know if you're going to call it the Southeast or not, but I will. That's definitely saw a lot of the benefit of a lot of folks moving there from higher priced markets for more favorable tax situation, lower prices, favorable climate, and I think that Raleigh still has some opportunities. I do think that that's probably in the bucket of rode the last wave, in that it was underpriced a few years ago and then got a lot of investment activity lately, meaning that it'll be a little harder to find a deal there, would be my personal opinion on it. Doesn't mean that there's not good deals to be had, though.
Hey, look, we're doing a deal in that market right now. Now it's a LIHTC, low income housing tax credit, but it's trading at 57, 58 a door. It needs a lot of work, but it's still, and there's significant upside on the rents. So there's opportunities like Matt and Joseph said in different markets that you can find select. You don't see it every day. So.
And some of the bigger players in the multifamily space that I know really like all that Southeast, right? So if you come down from Raleigh and Charlotte down through Dallas and, encompassing all that north side of Georgia and Alabama, which would be Atlanta and Huntsville, all those markets in there have been hot and continue to be hot. And, again, and I'm just throwing this out there because I've always kind of shied away from the Midwest. I don't like snow, right? But this Tulsa market, when I look at that, I believe that Tulsa is right where Indianapolis or Huntsville was a decade ago. We're definitely there, Ray, before the smart money catches on. So, Hey, Matt, I want to ask you about 1031 money. And, there's a lot of investors that have money on the sidelines, maybe 1031 investors that are thinking about moving money and utilizing a 1031. So I kind of have a twofold question. How much money's out there in 1031 money for equity? And how many of those 1031 investors actually miss their boot and, wind up, having to pay the tax anyhow?
Well, I don't think I can quite sum up exactly, how many. I will say in the DST 1031 exchange market, the market that I focus on, it's been a slower year for 1031 exchange money. When the market's high, more people sell. When the market's slower, it kind of goes with the swings. But if someone's selling property that they've owned for a number of years, if they have an appreciated gain on the sale, whether the market's up or down. If you've owned your property for, 10 or even less, maybe 5, 10, 15 years, you're going to realize a gain. So bad news is you're selling into a market that maybe isn't your favorite market to sell in. The good news is you get to buy back into that market to complete your exchange. So in a lot of ways, when you're looking at an exchange, it's important to think forward and just think of it as one ongoing exchange as opposed to every single piece of it and trying to hit a home run every single time. But you asked how much money, the DST market here, I can actually look it up here while I'm talking, but the DST market was still I subscribe to a company that tracks these sort of things, but the DST market is on pace to do, I believe, 30 billion this year. To put that into perspective, coming out of 2008, I think they were at less than 100 million. So I mean, things can really swing quickly. So there's a lot of money in place still. And as far as people who miss their boot, so in a 1031 exchange, you have 45 days to reinvest the money. There's a lot more nuance than that, so don't count that as tax advice. If you want to learn more, we can talk offline, of course. But really high level, without getting into the details, you have about 45 days to identify new property, and then 180 days to close. We're all real estate people. We know that's not a lot of time, and so it definitely happens where I talk to folks on day 46 and they say, hey, I'd like to identify something, or I'd like to do one of those 1031 exchanges that I've heard about. It's like, yeah, I'm sorry, I can't help you. Or they just sit on things, don't want to make a decision. Maybe they do identify things, or maybe their property is just taking too long to do due diligence and they can run out of their 180-day window. So I don't know if I have a number on that. I would say by the time I'm talking to folks, I would say it's not rare, but I would say it's a small percentage of folks that I talk to, just because luckily, I think for people are getting educated on it. It's more popular than it used to be. So people actually know the rules. They have enough people in their professional circle to help advise them on what to do. So I do see folks with busted exchanges that we work on. It definitely happens.
Yeah, interesting. Hey, I want to talk a little bit about short-term versus long-term outlooks. I'm going to kind of throw a question out, and Joseph, let's start with you on this. But, should investors be focusing on short-term gains or adapting a more long-term perspective when considering investing in multifamily today?
I mean, I really think you need to at least look at, in the multifamily space, 7 to 10 years out. In the SFR space, you're between 5 and 7 years out. I mean, the average investor doesn't really do something with their asset on average every 7 years. So I don't think we're going to have real true economic balances here. In check and balances, we won't see a softer rate compared to a higher rate probably till year 4 or 5 of this 10-year reset. So you might as well look at the long play here, because there might not be a lot of options on the short play. So a lot of my investors are taking 10-year interest only options on a 30-year amortized loan on more small balance. And on the larger stuff, above 2 million and above 25 units, a lot of my borrowers are taking 7 and 10-year options on 30-year amortized loans. On the SFR stuff, I try to sell the idea of 10-year interest only, but my clients, listen, if the deal works at a debt service of 1.0 better, and it's at an 8 or 9% rate, can you imagine when rates come back down to 6%? What that spinoff of cash is going to look like in 3-4 years? They're going to look like rocket scientists. They're going to make the Huntsville concentration of engineers look like lightweights. So you tell me. I mean, rates are only relative to how you buy. So the same with, like, I have one client that's working on value add multifamily that he's turning them all motel conversions and turning them all into Section 8 housing. He's taking properties that are worth $50,000 a door, throwing 10 into each one, and they're coming out on the back end at $90,000 to $100,000 a door. You tell me where you're going to be able to make that kind of money in the multifamily space, and the states are throwing money at him to fill those one bedrooms out because they don't impact the educational base of those communities at all, because children can't live in a one bedroom. Okay, they're going to try to sneak some kids in there, but that ain't going to work out long term. So the long term play on those properties, they're spending off so much money and not even 70% loan to value on the back end. We're talking like maybe all in leverage at 65%. I would never sell those properties. They're going to go to my grandchildren.
Yeah. Yeah.
You know,
Makes a lot of sense. How about you, Matt? Any thoughts on that?
Yeah, actually, that kind of echo what Joe said. I mean, I think cash flow is king when it comes to being able to, whether you're looking at long term or short term, you do need to make sure your deal pencils out and that you're getting cash flow coming in. If you want to be a conservative investor, it depends on the type of property that you're working on and the type of deal, of course. But at the end of the day, you need your debt covered service ratio to be where it needs to be, and you need to know that you're gonna, whatever amount of debt you put on it, 50%. I'm working with some properties that are in the 30s as far as LTV, and you can get more than that in certain types of properties, and that's okay if it still pencils out for you. But cash flow is king in that regard as far as in the defensive play. And then also, I was at an industry conference not just a couple of weeks ago, actually, and one of the sponsors there mentioned something that kind of stuck with me. He said, interest rates are short term and basis is forever. So where you buy your property, if you still get a good deal today, if you can still make a cash flow and you can see the light at the end of the tunnel for what you're going to do with the property. And well, I don't want to do it because I don't like where interest rates are. Well, interest rates, again, they're short term. They're not going to last forever. Maybe they stay high, maybe they go up, maybe they go down. But at the end of the day, if your deal works, the deal works. And just sitting and waiting for a different interest rate is probably not the wisest. If that's the reason you're not doing the deal, it shouldn't be the only reason why the deal should die. I mean, if it makes sense, I think that there's still opportunities even with rates where they are.
How about you, Ray? Cash flow or growth?
Oh gosh, well, it's actually a combination of both. And taking into account interest rates, I mean, if you can find deals where you are buying them with an assumption in the 3 and 4s, those are phenomenal deals, and that's something that you should capitalize on. We do see some of those trading. I'm doing about half a dozen right now where they're assumable debt, and you can come in there and you can pick up that 4% interest rate for another 5, 7, 8, 9 years. It makes the deal pencil incredibly well, especially with the rent growth that you're still seeing. So you combine that interest rate combined with 5% rent growth and strong occupancies in workforce housing. As you said, there's still a huge demand for it. It's going to continue for the foreseeable future, and so that's why I kind of say both.
And I agree with that, and I'll throw one more thing in there. I think it's okay. Let's just say you are interested in a deal that is more short term. I'm going to call, we'll say, I don't know, 3 to 5 years or something like that.
Yeah.
I would say just make sure the deal works out so you can hold it longer. To Mike's point earlier about cycles, nobody really knows. You can listen to economists, you can listen to experts.
They're all wrong.
If you want. Nobody knows. Yeah, nobody can predict the future. That's just the fact. And so at the end of the day, if you are in a short-term deal and that's your investment criteria, and that's what you want, fine. Just make sure that you don't have to exit in year 4, right? Make sure that you have the ability with the debt that you get, you don't have maybe a balloon payment, or you don't have, some kind of agreement with your other partners to where, you actually have to exit this. I think the ability to turn a short-term into a longer-term hold might hurt your long-term bottom line as far as maybe you're hoping for a higher return, but it could definitely save you from a disaster if you're.
Yeah, and Matt, you're totally spot on. Case in point, just before COVID hit, I was headed to NMHC, National Multi-Housing Conference it was in Orlando, Florida. There's 5,000 or 7,000, apartment guys attending this event, and I've gone for 20 some odd years. But I was working on a 240 unit in Oklahoma City, and I was with the owners, and I said, "Look, guys, nobody can read this, but barring some black swan event, this is literally a month before COVID was announced, and I'm flying out there. They opted to go ahead and sell this property, not on my recommendation. I actually told them to hold it." Okay, I was the one who said hold it. I had a partner with me who said, no, sell. And so they went ahead and sold it. They probably left about 20,000 a door on the table during that transaction. But nobody could have predicted what was going on. Nobody. And COVID hit. It changed the market, changed the dynamics. So even the smartest of us, we don't know.
Yeah.
We can understand and we can learn from our history, but 100% certainty, absolutely not.
I was hoping if you just said, okay, at the beginning of this, what's going to happen with the real estate market? I'd have been like, boy, bad time to be a real estate investor, and how wrong would I have been?
Yeah, absolutely. Yeah.
It was scary. I was scared, right? I mean, to say you weren't scared, I don't know. You might be. It was just like, what's going to happen? Nothing like that had happened before. So it had something like that happen before. You can say, well, last time this happened, and it still could have gone differently.
Yeah.
We can't predict the future, so you just got to prepare for, I think, multiple outcomes.
I love that. Even the smart guys don't know, Hey, let's talk about risk mitigation a little bit. Ray, I want to start with you, but what risk mitigation strategies do you recommend for investors looking to enter or expand their multifamily portfolio right now?
Look, there's fundamentals in this business, and it has not changed in 35 years. I've watched this time and time again, consulting analysis on properties all over the country. I'm in Houston, Texas today doing that exact same thing. These fundamentals do not change. Great, and you're done. I can go sit and drink Mai Tais on a beach somewhere. Doesn't work that way. You have to be proactive in your operations. Make sure that this property is operating optimally. It's managed correctly. I don't call them tenants. I actually call them clients. Your tenants or clients in the property are well taken care of, because I see that are phenomenally successful. And these guys own 20, 30, 50,000 units. They do those fundamentals day in, day out correctly. And that's the key. The growth will still occur. Obviously, there's going to be some market challenges in certain areas. But overall, our
points, learn about real estate in multiple cities, not just one city. I mean, you need to have a couple eggs in the basket, not all the eggs in one basket. Select the right city to invest in and dive into. Okay. Understand the micro market and its trends. Select a project based on its functional attributes. 25 unit or 30 unit makes sense. Or maybe an SFR portfolio of 60 doors might work out just as well, and understanding, your own financial time horizon, understand what your financial capabilities are. I mean, I have conversations with clients every day. I have X amount of dollars. I want to buy X amount of properties over the next 12 months. That's where, this hairdo has earned my keep, because I've been in the industry quite a long time. And I the individuals that are inside sales at a lot of these lending sources, they've been in the industry about a half hour. Yeah. Okay. And I've been in the industry 24 years as a lender, 36 years as a real estate agent, and an instructor educator for 10 years. It's like they got freckles from when they just graduated with their prom. And then me walking in the door, it looked like I just went through a thunderstorm and lost my aged a little bit. But you know what? The expert in this field right now is the one you want to sit down and break bread with and build out a power team with. So what I'm doing for my mini whales and whales, I'm building out their power teams, and I'm becoming a very valuable asset to them, being a connector as well as a strategist and as well as a closer for them. So I'm playing multiple hats in this space to mitigate.
I love, if you look at the four of us on this call, we have about 100 years of experience in this business, right? And when you take that collaboration of experience and knowledge and you bring that to the market, there's a lot of knowledge here. And one of the things I work with on my coaching program, whether it's my group coaching or my personalized coaching program with people, is how to look at markets. I'm a market-driven investor. When one of the brokers in Ray's office brought me this Tulsa deal. I said, you could bring me a stellar deal in Chicago, and because of the politics, I wouldn't do anything there, right? So, it is market driven, and I think a lot of this makes sense because of the markets. Matt, how about you?
I think that, we're getting probably to the end of our hour here, so I'm just going to probably head. And Mike, what you just said, I mean, no one is saying, hey, just go with your gut. No one's saying do what seems right to you. I mean, everyone's talking about finding the right team, right? Working with the right professionals, and that's probably professionals, right? Not just professional. Right. So, I mean, you're probably going to need to work with folks who've done it before, and you should have another number of different people on your team. A lot of them, and then really learn how bad it can get, right? After getting bought up. And with the 1031 exchange sponsors I work with, before the recession, I think there was something like 40 or even 50 active sponsors doing what they do. And after the recession, there were only 5. And nowadays, we're up back into the 40 or 50 range. And the sponsors didn't necessarily just poof disappear. Someone just ceased operation for a while, slowed down, what have you. But the point in that is we don't know what's coming, and working with the right people and taking the right defensive. Still in the asset gathering phase, with just that one asset they might be selling and then exchanging. And so one thing we do is pair leverage, and maybe Joe can speak to that, but we'll take folks who, we don't like to over leverage anybody, but for people with the right situation, you might go from a debt-free sale or a very low debt sale, and then an opportunity to expand your portfolio without really having to do much is simply take on a bit more debt. And I'm going to hedge that and say conservative, the right debt, the right LTV for you, but you go from a very low debt position.
New finance deals. That's actually, if you look historically, that's normal. I mean, that is normal. I mean, I have war stories from back in the 70s of 21% debt. Yep. So 8% is not horrible. It's not that bad. As long as, again, you fundamentally, you acquire it right, you do your math, you innovation. If you have those people in your corner, they're going to be guys and folks that will help, develop your portfolio. So, yeah.
Yep. I came into business in the early 90s. We were just coming out of double digits. So for me, this is normal, right? Because we worked our way down from there. Last question, guys, is what's the impact AI is going to have on, the industry? How does it help us? How does it hurt us? How do we use it?
Well, I mean, I think AI is here already. It's not like how it's going to apply. It's a matter of what industries is it going to impact the most. I think it'll impact the real estate agent space, the title space. At the end of the day, somebody still needs to manually underwrite a deal. So I think the most impacted market industry sectors of real estate will be the real estate agent, the appraisal, and the title space right off the bat. Okay, because you're going to already lose 50% of the realtors that weren't even really making any money anyway over the next 12 to 24 months. And title agents are going to combine, consolidate, go out of business, disappear. And then and appraisal, that is going to be the biggest impact in our industry that nobody's talking about over the next 24 months. It's a very aged industry. People are coming up in walkers and canes that do appraisals. The average age appraiser is 54 years old. So it's not getting younger, it's getting worse. Okay, so I think you're going to have a lot of shifts.
Done too.
Well, an MAI appraisal takes 3 weeks off the bat, even if you expedite it. So there is going to be the biggest impact on how that gets deals done, and surrounding yourself with the right lenders that understand AMCs, understands title options and underwriters, and understanding the right realtors to work with throughout the country is going to be extremely important, because at the end of the day, I think AI, the last sector of AI will impact is the lending space, because you still need somebody to talk to understand the deal, and AI can't understand sometimes what we call common sense or experience. So I think we're to the advantage on the back end, but I think those other pieces are going to be extremely impacted over the next 24 months.
How about you, Matt?
I'm gonna say actually something that as opposed to, how do we use it? I'm going to go ahead and say technology security is going to be something that I think is just a bigger focus. I think that firms, lenders, anyone in the financial industry is really focused and has been trying to do what they can to stay ahead of IT security. But I'm going to say that is one of just the most important things to focus on as far as technology. Today, I got yet another layer of security that my firm pushed on me. I have to have this app on my phone, and you get your text message to put in the code. Now I've got an app that I have to scan something, and it's a huge pain in the butt, and I hate it, to be honest. But you know what? That kind of thing is really going to become more and more important, because as computers get smarter, more sophisticated, you don't need human hackers behind the scene, or you need just one human hacker to really pull off a very sophisticated financial heist, if you will, or who knows what. So I think information security is going to be it is paramount now, and it's only going to get more important.
Only going to get more, yeah.
Yeah. That's why I think third parties help a lot. Like on our investor platform, we use a third party vendor, and their security is very high, and we're assured that our investors' privacy as well as their personal information is kept intact. Which, very important to have a good vendor with a track record. How about you, Ray?
Yeah, so it's kind of a culmination of several factors, and I echo Joseph's comments about streamlining. We're seeing you're still going to have a demand and need for professionals in the market that have that knowledge that AI will never be able to replicate, just because they have certain things they know that occur. And AI, albeit I think will be a prevalent factor, it's not going to replace it. It's just going to get more streamlined, and you're not going to have every person in the world being able to go out and be a broker or whatever. It's going to get more focused. Number two, I love this. I mean, I have multiple investment properties. I get an investor portal. I can go look at my assets. I can look at what we're making 24/7. I can access those accounts and see how well we're doing performance-wise. And then if I have an asset that needs attention, that's where I focus on. If they're performing where I expect them to perform, or if they're within budget, I'm not there. I want the ones that have the challenge. That's where I'm at. That's where I'm focused. And then lastly, things move incredibly fast. Deals come across our table and they move out the door, sometimes not even 24 hours. So that velocity is still continuing. And, that's what we expect with the technology that we have. I joke about it, but I'll close a 1,500 unit portfolio, and I'm sitting on a beach in Puerto Rico. So it's crazy. Back in the day, there's no way in heck I could have left, but today, yeah, I can do it.
Yeah, very interesting. Thanks, guys. Hey, I want to just thank you guys for being here tonight and taking time out of your day. Appreciate it. I know that Ray, you're in Central Time, and Matt, you're in Central Time. Joseph, you're in Eastern, and I'm on the West Coast. So we're kind of spread out all over the place. But I really appreciate you guys, your insight and your knowledge. Joseph, why don't you start off and tell people how they can reach you, where they can find you if they have an interest, and we'll just kind of go around the curve here.
I can be reached at 215-290-5108. And you can reach me at josephvscarice.com. That's Joseph at josephvscarice, SCORESE.com. Thank you.
And Joseph, you can find you on social media and Clubhouse and where else too.
I'm rebuilding out my podcast, which will be called Creative Burst Strategies, and the website josephvscarice.com will be up by New Year's Day.
Perfect. Thanks, Matt.
Hey, I just typed it into the chat panel. That might not be a bad idea for the other folks on the panel, but I was putting the chat there. Matt F at Chicagoland1031exchange.com. If you just want to learn about 1031 exchanges at more of a high level, you can just go to Chicagoland1031exchange.com. We got a lot of information on that educational material on the website, and then also on my phone 651-829-5698.
Thanks, Matt. Ray?
Yeah, you bet. Raymond Lord with R Lord at svn.com. That's SamVictorNovember.com, and 918-850-1779.
Hey guys, thanks for being here tonight. And if anybody wants to reach out to me, you can find me on my website at MikeMorawski.com. You could send me a direct message there at mike@mikemorawski.com. If you're looking for more information on passive investing, you can grab a hold of my passive investing ebook. Just shoot me a direct message and I will go ahead and get that out to you. And you can find me on social media. Any platform where you hang out, you can find me there. Instagram, Twitter, LinkedIn. And if you're over on Facebook, join our community at Multifamily Unplugged. On Facebook, we're always exchanging information there. It's a great networking opportunity for you as an investor. You're always going to see new information that we come out with. You'll be apprised of any events like this that we continue to do. And then, of course, on our YouTube channel at Mike Morawski. So I want to thank everybody for being here tonight. If anybody has any last questions or has questions after this, don't hesitate to reach out to any one of us. Everybody have a great evening and good rest of the week. Good luck, guys. Thanks.
Yeah, thank you.
Take care, guys.
All right.